Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host. I'm once again joined with my good friend Doug Heagren. Hey, Doug.
Hey Kirk, at first I thought you said, when you said glad to have you aboard, I thought you said glad to have you bored. And I'm like, well, that's an interesting way to kick off our show today. Well, hopefully we set that bar down low and then we just leap right over
Yeah, there's no sleeping on this show. I'll tell you. You can do that. You can do that at night, or as Chevy Chase said in Caddyshack. Well, sometimes I sleep during the day. So,
Right,
all
exactly.
right. So, all right. Well, let's just dive right in. So, Doug, how was your Independence Day?
Independence Day was great. We just, as we said kind of on the last one of the shows, we just got back from a long trip. So this was one of the rare Independence Days where we didn't go anywhere, didn't have any major plans. We stuck around. My son is in Cub Scouts, so they participated in one of the parades, which was great. Got to hand out ices to families and ended up like racing to chase the car because it's the fastest parade I've ever been to in my life. It's like the car's going 20 miles an hour. We're all trying to keep up. So we're handing out ices. And then on top of that, it was interesting. I saw a lot of news reports this weekend, Kirk. I don't know. We started noticing in our neighborhood for about 5 days prior to Independence Day. It seems like everybody was really into setting off private fireworks this year, and not something we had been overly, it had really overly been a problem or significant in our neighborhood the last couple of years as we moved in. Thought it was just crazier than normal this year. It's come to find there's a lot of reports around the country of this being a problem. I mean, I think in Minneapolis they're firing bottle rockets at police officers. People are shooting at drivers as they go by. So I don't know as the year. I don't know if it's because we're now a couple of years removed from COVID and the crazy's really starting to leak out here, Kirk. But this is the year in which people decided to really arm themselves with fireworks and go to town, in many very exciting and yet potentially mischievous ways. I don't know how it was in Boston, but it seems like there's just every day I'm finding more reports of just fireworks, misuse of fireworks everywhere. So that was a very exciting 4th of July in that regard.
Yeah, I had it's funny leading up to Independence Day. We had I saw a funny and not funny video at the same time of like this family sitting out the front yard and they let off some sort of bottle rocket or some sort of display, and something went awry and it went up and landed right next to their car, which so happened to be where there was a pile of fireworks. And like when the thing went off, people kind of scattered the first time. So they're like, oh, something happened. So like half the family scooted off the view of the camera. And then part of the firework landed in the pile of fireworks. And the whole thing, like watching, I was like, holy crap. Like it was like, it wasn't a bomb, but it looked like they could have burned a hole in that concrete with the amount of fireworks that was in there. It was amazing, and happy nobody was standing there because it looked like everybody scattered, but just amazing that some people can do really stupid things. And I will say this, that unfortunately in Massachusetts we're not allowed to make decisions for ourselves. So fireworks are
Neither are
illegal.
we.
Fireworks are illegal in Massachusetts because it's dangerous, and
Mm-hmm.
we got to keep dangerous things away from people. So let's tell people how to live and don't use fireworks because they're bad. Well, so my way of celebrating Independence Day was to go up to New Hampshire, buy a bunch of fireworks, and light them off up there. Totally legal, right? So went up to see family. We do an annual fireworks display privately because I don't want to lug around and sit around with a bunch of people and see a crappy fireworks display. We were in was recalling over Independence Day that my wife and kids and my in-laws, we went to see the Boston fireworks, which have always been great. And
Mm-hmm. I've
one
seen them.
year my kids
Yep.
were, I think, 2 and 4 or 3 and 5 or something like that. Anyway, so we decided to go see them with the kids. Well, my youngest melted down around 9:30, which is when they're always supposed to go off 9:30. He melted down, so my wife had to take him home. And then my oldest fell asleep. He stayed up until 11, and then they went off at like 11:20. So he missed them, and it was just a mess. Too many people, and they're always supposed to go off early. They never do. They go off late. I mean, it's just to me. I would much rather just spend whatever few $100, go buy some fireworks, have a private display in the yard for the family. It's so much cleaner and easier. You don't have to deal with people. You don't have to deal with parking and all the other stuff that comes along with it. So maybe that's my introvert sticking out, but that's how I prefer to choose my Independence Day. Other than in 1986 when I celebrated independence from the aliens, because that was truly the most momentous Independence Day that I can recall was 1996 when that movie came out. So
absolutely, Independence Day. It was kind of cult following ever since. Two last things I'll take away, and it's a good segue because we're talking laws, which probably would segue into some other things we could talk about today. But a couple things. First of all, I saw several videos like you did. I saw the video you're talking about. I saw another one where this couple was standing on a porch and all of a sudden neighbors firing off fireworks, and then boom, one comes shooting at them. I've seen like 4 or 5 videos from this. So the first question I have is, what is wrong? What wrong? And again, this might be a COVID thing in the supply chain, right? Because we've had trouble getting chips for cars. We've had trouble getting washers. I've had trouble getting a hot tub I've been trying to put in. There's all these things that are going wrong in the supply chain. I'm thinking something occurred with the supply chain for fireworks, because what is up with all these sideways shooting fireworks? It's just, they're not built to be this way, but there's all these videos this year of these fireworks firing out to the sides.
To be fair, there's always problems with fireworks. We just didn't see videos prior to now.
Well, I mean, YouTube's been around for over a decade, and I'm still feel like I'm seeing more of them this year than I have in the past. The second thing, too, of course, this does not count the people in Minneapolis that were aiming them sideways and firing them at police officers, which, again, we don't recommend. The second thing that on this that I was questioning is, when I grew up in Ohio, this was the funniest thing. We had fireworks stores everywhere, and I live in Minnesota. We don't really have fireworks stores around, but if you go across the river to Wisconsin, they have fireworks stores everywhere. But the fireworks are legal. Fireworks are the funniest thing because it's the only thing I can think of where it can be completely illegal in the state, but they don't have a problem with you selling it. And in Ohio, they would make you sign a waiver saying, you can buy this. Do you promise to take it out of state? In other words, we'll sell it. We'll get the tax. Sign this waiver saying you'll make it somebody else's problem.
I love it. I think that's great. I think there's nothing like politics to ruin your Independence Day.
Here's a crack house. Listen, we will sell you the crack. Only use it in the other state, please.
Use it responsibly.
Right. Wait, Kirk, here's an opportunity for me to do it again. Here, we're going to sell you heroin because, we got to bring that up every couple months or so. But here, we're allowed to sell you heroin in this state as long as you promise to sign a waiver that you'll use it somewhere else. Blake, speaking of laws, a good segue to talk about constitutional law. And I believe there was something that came out recently having to do with some decisions of constitutional law. There's a big one, Kirk. It's not coming to me. But I might be indebted to my memory here. What could it be, Kirk? Does anything come to mind that might have come up recently that's caused a few ripples in opinion?
SCOTUS?
Yes, the Supreme Court.
You want to dive into that, or you want me to start, Doug?
I was teeing it up for you to at least go down the road there, but I'm happy to start with it.
So let's start with the SCOTUS rulings. I'm not going to dig into the politics here, but I do want to use this as an opportunity to talk about mindset, as we always do in the show. Mm-hmm. We take a political topic and we don't talk politics. We just talk about the way to think about it. So here's another decision. So if you think about let's start with the most political opinion of all, Roe v. Wade. And I'll start with this one because it's interesting, right? Here's a law that was basically in place for, I think it was 40 years or something like that. Long time law that all of a sudden got overruled. And I'm not an expert on the legal part of the case, so I'm not going to sit here and judge whether it's right or wrong. But I will point out one piece, because I think this is the part that I want people to take away. No matter what you think about the decision, right? And I'm kind of agnostic. I've got opinions, but I'm not going to share them. Here's the way you think about it, right? Is people pitted it as it was pro abortion or anti-abortion. Like that was the issue. But actually what it came out was that it was actually going from federal rights to states' rights. Now you can argue whether that's right or wrong. I'm not here to talk about whether it's right or wrong. I'm here to talk about how to think about it. Now, how many people actually characterize the decision as federal rights versus states' rights? Now, as a republic, it was always about states' rights. And I think generally speaking, for government, it should always be bottom up instead of top down, because bottom up is where you get the people, right? You get your town council. Well, I know these people, I know where they live, and they know me, and they know the town issues, but some guy in Washington may not know the issues. So if you want good governance, it's always better to be local. That's my opinion anyway. But if you think about this issue, all it did was bring it to states' rights. So if you want to get angry at somebody, you should get angry at your state for not for allowing it or not allowing it, right? That's the point, right? That's why you elect officials to make these decisions. So like I said, I'm not going to get on the decide of which one's right or wrong, but I want to point out the fact that what it really was deciding was federal rights versus states' rights, not whether people should allow abortion or not. I don't believe that was the issue. Now, getting into this one, you have another very heated issue, right? You have basically two issues that were big that I want to talk about. One is the affirmative action, the Harvard case, and the other one was student loan payoffs. I don't think anybody other than people who are completely misinformed thought that SCOTUS is going to rule in favor of it's okay for the federal government to just absolve students of loan debt. I don't think anybody thought that was realistic. I think that was basically a stump way of getting attention for politicians and to look good for the constituents. I mean, that should be legislated by Congress, not by the president. And I think that was really where that rule came down. So interestingly enough, like I said, I don't really have an opinion whether it's pro or con. I mean, I do have one, but I'm not going to inject that into the conversation. I'm more pointing to the fact that these are decisions that are taken in the media and blown up to be pro paying down student loans or anti paying down student loans. It has nothing to do with it. It has to do with the fact that it should go through Congress. Let Congress decide that. That's up to them, right? And if they decide pro or con, then we have something to talk about. But you can't have, I couldn't stand up and say the federal government is going to forgive student loans because I'm not Congress. And whether it's the president or Supreme Court, whatever it is, like that's not their job. The Congress' job to do that. So the other one was the affirmative action, which, funny enough, was not a surprise to anybody. So I knew about this ruling coming down like 6 or 9 months ago. Like this surprised nobody. Like I think everybody knew about this well in advance that it was going to go this way. And frankly, it brings up an issue that deserves conversation, right? Which is, is affirmative action right or wrong? I don't know. Like I said, I have an opinion. But what's interesting is this is not a Caucasian versus African or Asian descent or any of these others. It was literally like Asians versus other minorities, and like it's a battle of who's got the best affirmative action. So I think what it does is it positions it interestingly in the fact that things are going to change, right? But no one was surprised by this. Right? I mean, some people are because they didn't know about this, but people in the college space, nobody's surprised by it. So I think what'll be interesting to see is how the colleges handle it, whether it's enforced, whether it's something that's whether the colleges come up with another way to do it. But I think it'll be really interesting because it's going to change the landscape quite a bit, and people are going to claim, "Oh, well, I don't have rights." Like I don't know. Right? We'll have to see what happens. But I think the first volley in the news was what I call kind of fog of war. So fog of war, what is that? That basically means the first things you hear are probably inaccurate. Not because the opinions are wrong, but because things are still really early to tell. Because so many things are going to happen from a week ago until 5 years from now that are going to change the landscape of the colleges anyway. So, I mean, think about AI, think about online learning. All these things are going to change the landscape of college. So, I think there's going to be different anyway. And this, you could have your own decisions on this, but I just wanted to kind of point that out. It was a big deal. We didn't talk about it last time because I don't know, we just didn't.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here. See? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Any thoughts, Doug? Because you're in the college space. So how does this impact like the college space for you?
Absolutely, and I think the interesting thing, I think you made it a very important distinction when you went back to the Roe versus Wade, which was they struck down a 40-year law, and really I think that comes to the nuance of what's going on here, right? And people that are, if you understand the way, people understand the way the government structure works, it isn't actually striking down a 40-year law. It's striking down or reversing a 40-year opinion, because remember, the Supreme Court can't make laws. Neither can the President of the United States. And so I think, again, we're not taking political sides here, but there's a lot of political mudslinging going on over decisions, politicizing of these decisions. And yes, let's not discount that there's always going to be a slant depending on the way the Supreme Court may view things based on those members and their backgrounds, et cetera. But the point here is that law has to be made by Congress. Right? Congress has to make those laws. Once the law is made, and you know this, Kirk, a lot of laws are left to an incredible level of ambiguity. They don't like to make laws too rigid. They leave them open to interpretation. Once that interpretation is established, that's where you get executive directives that the executive branch will basically enforce the laws. And that's where states will enforce laws, based under those things. And then effectively what's going to happen is it's going to end up in the courts, because people are going to go back and say, does this meet the main law, which is the Constitution? And that's where the Supreme Court comes back and says, look, based on the way we interpret this, we believe that the law or the specific case that we are looking at, should that have been a law under the guides or the powers that are allowed by the Constitution? And that's where it gets controversial, right? And depending on the view. So as you go back to states' rights, states are passing laws. Those laws must be legal underneath the Constitution. It's obviously up to the Supreme Court in those cases to decide if it is. That's all they're doing. Would the Constitution allow this or not? So what's going on with the colleges, and I think you brought up another distinct detail, is interestingly enough in this case, as you said, this isn't like, they're letting all of these affirmative action cases, which have historically been thought of as being racial minorities, into these schools. This was actually brought on by racial minorities that are looking at the affirmative action viewing and saying, hey, wait a second, now it's working against us. We're actually getting capped because schools are looking at, we're looking at this saying there's only so many people you're allowing from us in based on our race. And so what they came back and said is, we want to limit, we think our merits should get us into these schools, and there should be no consideration whatsoever in regarding race, background, ethnicity, etc., in terms of these selective decisions. Now, as someone involved in the college planning space, this is very complex, because what schools are trying to do is they're obviously trying to help and bring on a diverse student body. There's been a lot of pressure to create diversity. There's a lot of pressure based on economic background and other variables that are that have arguably made it easier for some demographics than others to be able to have the resources they need to prepare for college and get the grades and the merit to do so. And so the schools have tried, under the guidance of fairness, to say, look, we want to bring in more diversity, show that we're diverse. This is good, and so they've used this as a way to try to create these quotas for establishing a diverse population, and maybe helping to get certain, maybe less privileged populations and demographics into schools. Now that this goes away, okay, it was always incredibly difficult. As a college planner, we look at kind of what is it the schools are looking at to get people in, and how it is position yourself to be effectively recognized, because college admissions, they have a very limited amount of time to be able to look at one application to another, and they're getting inundated with thousands of applications in some of these schools. So how do you go about that? Well, GPA, okay, there's one thing, but COVID proved, Kirk, that GPA can be manipulated very easily. Like, one school district was, when they went to virtual learning, for example, one school district may have actually had live taught classes that you had to show up for with attendance and still graded on a typical 4-point scale. Another school may not have had the capacity, the resources to do that. Everything was kind of put into a file. You went in, you did it, and it was pass fail. Now, a pass-fail person effectively gets a 4.0. Colleges have struggled. How do I look at GPA and know how it is from one school to the other? So they have effectively gone back and looked at, using test scores. They've gone back and looked at other things in order to kind of scale. Essays are big and things like that. But demographics was one way they could say, look, at least we can carve off a certain segment here and say, like, we know that maybe the test scores aren't the same, the resources aren't the same, but we're going to help and make sure that we bring these people into schools. Now, I think it's going to put a tremendous amount of increased weighting on those metrics let's face it, demographics and affirmative action are controversial. So is standardized testing, right? And those type of metrics, and as you're getting more schools that are now test optional, they're saying you don't need to submit them. It's going to make it even harder, I think, in some ways, for the schools to be able to go through and identify and bring in individuals to evaluate individuals. I think it's going to make it even harder to create diversity within the colleges, for better or worse, in the way the process was. So I don't know. We're kind of in a Wild West now with this, because it has been so heavily embedded as a part of many colleges' admissions criteria to kind of segment these things, these groups, and then look at, okay, how many do we take from here and here and here? And I think we're going to find out over the next probably decade. But I think the bigger thing from the aspect of everything else we're talking about, Kirk, is how does this, now that there's an interpretation of not being able to use this in this situation, how does this ripple down into other things like hiring, employers, employment hiring, and a lot of other areas where there have been equal opportunity laws in place that have utilized, these past rulings and these past laws. And so I think we are really opening up a new world here that's going to remain to be seen. Now, I want to go back to the debt side of things. This is going to be very interesting because, again, a lot of people relying on trying to be able to get their debt waived for college. And I look at it from a broad economic standpoint. Here's the big impact that I think that is started to get a little bit more talk. But a lot of people were very confident that the student loan debt was going to get waived. Not really people in our circles, but I think a lot of people were just kind of this hopefulness that had debt, that maybe there would be this all of a sudden this windfall, this what's the word I'm looking for? This miracle, right? That would come and just free them up. And since COVID, there has been a continuously extended deferment of college student loan payment. And it's created this, I think, a little bit of a false security in our economy there, Kirk, because, if you're looking at at your budget, and you're looking at rising inflation, and you're looking at potentially, thankfully the job market has been hot enough that it's really been heated and helped to keep that income rising. We've seen some spikes over the last couple of years, but we have seen credit card debt go up. We have, after a brief payoff period with the stimulus from, that was coming out from COVID, all of a sudden, for a lot of people, I think that, people get used to their day-to-day budget, Kirk. You know this. It's like when we don't have to pay it, we don't plan for it. I don't know, maybe it's a secret to some people out there, but we have a fundamental problem with financial planning in general, as you know. And so as people have not had to pay this, and they've seen these rising costs, Now, all of a sudden here in the next, with the next month or two, we're going to start seeing those deferment extensions end. And what that means now is that, and it was going to happen 30 days sooner than had been planned, but now all of a sudden people are going to have to start paying on that student debt again. And that's going to be an added pinch to their budgets, which I think is a good segue to one of the charts I believe you have, Kirk, that we looked at, is that household savings has started to diminish significantly. And I think people have been using that household savings along with credit cards. I work with an individual who is in the industry for debt. They had a massive spike in payoff of debt coming out of the stimulus in 2021, early 2022, to, I mean, we're talking billions of dollars of debt paid down, but it has now spiked up. I think, and don't quote me, but I believe he was telling me it went from about 70 billion down to about 40 billion in debt, credit card debt out there, and is now spiked up to 100 billion. So now we've got people, we're higher than we were pre-COVID in terms of credit card debt, which means, again, as we know, credit card debt means you have to have a monthly obligation. Now you add a higher level of debt, which means a higher level of minimum payment. And then on top of that, you add the rising interest rates on credit cards, which I've seen some talk starting to come out there of people wanting to cap. I think Bernie Sanders said, that may be Bernie that came out and said, we need to try to cap credit cards no higher than 15% or whatever that might, or some sort of cap there. But guess what? If we've raised the interest rate of credit cards to 15, 20%, that's a higher minimum of debt obligation every month. Now you add in the fact that the debt amounts and the balance has gone up. That's a higher obligation per month. And you're starting to see here on this chart that there has been a significant drop in the U.S. Savings estimate, level of savings, the savings rate, all of which are plummeting and all of which are expected to start going negative. Now you add on the student loan debt as a obligation on a monthly basis. And I think this is where you start to get real concerns of exponential headwinds. Again, that could potentially lead to a significantly rising risk in terms of overall household confidence, overall household spending, and ultimately impact on the economy. And with that, I'll turn it back to you so I don't talk for the rest of the hour, Kirk, but any thoughts on that yourself?
Yeah, no, all great points, Doug. I mean, as we kind of look at this chart, I'm going to point out a few things because this looks ominous, right? I mean, you're looking at a chart and you've got sorry, I got a bug here. I'm trying to swat. There's you look at this chart, it spiked up in 2020 and then topped out, and then 2022 it started dropping and still dropping. And look at those dotted lines, Doug. That means that it could keep going in that same direction. Will it? I have no idea. But what I do know is that is a chart that's meant to influence your thoughts, right? Now, if they were really honest about the chart, they wouldn't have those dotted lines. But what they're trying to do is they're trying to hypothesize of what is going to happen in September and June, September of this year and June of 24. They're saying if things keep going in the way they're going, we're going to have 0% savings rate in June of next year. Am I worried? Not really. And the reason I'm not worried is because, first of all, this is a rate of savings, or a savings rate for the red one, and the other ones were level of income and level of savings. Sure, that does look somewhat ominous, but I also have been doing charts and data for long enough to know that could very easily spike up really quickly. And we're also talking about a change of 2% to 1% to 0%. It's a really small change. So I just point those things out because, well, Doug, what he's saying is correct. And I think all of the economic data point to this, and we've been pointing to it the last few weeks of, some of the data doesn't really look good. But you should also keep in mind, in the back of your mind, that charts are meant to influence. This chart, I only point this out not because of the rate, but because it's showing you, it's trying to prove something, that they're really smart and that they're going to be able to predict in the next year that it's going to be zero or negative by next year. I just don't know that that's the case. It is possible. Sure, it's possible, but I have no idea. and neither does anybody else. So I start with that chart just because I really wanted to point that out. Now,
now, Kirk, I want to go back on that because really quickly, that chart was not showing percentage; it was showing the trillions of dollars that have dropped. So we've dropped from about 3 trillion to 1 trillion in savings. So yeah, the predictions are great. We don't get into predictions here. We've talked about that many times, but we have already seen a significant drop. The chart is showing in several trillion dollars of savings. And so if that savings has been going down, and now you start to throw on some other headwinds like paying on student debt, higher credit rates. I mean, of course, these are things you need to watch closely. But of course, making any kind of prediction, listen, I think I saw the other day the new jobs report just came out. And the jobs report is they're saying showing a softening finally, right? Because the jobs report was less than it had been. But how many times, Kirk, have we seen the jobs report come in softer than we expected, and then the next quarter it spikes back up again, right? So there's so many different variables out there that could change things from 1 month or 1 quarter to the next. That obviously make predictions completely ineffective. But that being said, I think there's definitely some headwinds that are hitting the middle class, and we can see that. I think we have another chart on that. The middle class, in terms of especially starts to feel the pressure of some of these added issues, because they tend to be the ones that are taking on more of the credit card debt. They tend to be the ones that have had to rely more on student loans in the first place. And ultimately, there is a correlation. I don't know about causation, right, Kirk? There is a correlation between the middle class and the health of the economy.
So so I want to dig into some of the rest of these charts here. And so here's one that talks about the aggregate income held by the U.S. middle class, and it says.
And this is the one I was referring to.
Let me finish this. You can come back to you. So it says that the aggregate income in the U.S. in the middle class has plunged since 1970. Now, I really point this out because of the word plunged. I don't see anything about plunging going on in this chart. You're looking at 1970 to 2020. That is a 50-year period. And the middle class aggregate income in the U.S. has gone from 62 to 42. Now, granted, that's a big change, but that's over 50 years. That's not a plunge. So I just point that out because everything we read is meant to manipulate and is meant to influence your opinions. So always think about what words are they using? Why are they using them? That's not a plunge. It's like if you look at this chart, it's obviously the upper income has gone up from 29% to 50, and lower income has gone down by 2%. So, I just point that out just because of the plunge. I think it's just a really important thing to take away is that anytime you see these charts, look at the wording they're using and see how that's influencing you. Now, the next chart I want to show is, I think, is a really important one that doesn't get talked about enough. So this is the factory share of manufacturing worldwide. So what it shows is the big manufacturing countries. China's number one, around 31%. United States is around 16%. Japan, Germany, South Korea are similar between 4 and 6%. So I point this chart out because if you look at 2000 to pretty much today, China's share of the world manufacturing production has skyrocketed, which is like what we talked about on the show, right? The supply chain, everyone sent their stuff to China because it was cheap, right? You could send it there, they could manufacture and send it back. It would still be cheaper than manufacturing in the US. However, since the challenges we've had with China and, a lot of the saber rattling they've had and we've had, and it's not all one-sided for sure, but there's kind of been this collective agreement that connecting with China is not really a great thing because we have too much dependence upon them. And if things ever go awry with China, everything's going to fall apart in our country. We can't get raw materials. We can't get goods and services. There's just stuff we can't get. And this actually happened in the Cold War, too. There was a book I read, I forget the name of it, back in the 90s. I think it was written in the 70s or 80s. Anyway, the point was it was talking about strategic global resources. And at the time, we were competing with Russia, right? And we were concerned about making sure we could get all of the raw resources we needed for production if they ever shut things off or we ever went to war, right? We needed the resources for our country. We don't make everything in our country. We don't have all of the raw materials in our country. We're fortunate that we have food. We have ag in this country that many other countries get their ag from us because not every country has good soil. However, you go to China and they're getting a lot of lithium and other things that are, poisonous, really dangerous to mine. So we prefer to get it out of China. Some rare earth metals we get from China. I think 90 some odd percent of the rare earth metals come from China in the world. So there's things like that that are really concerning that I think, both countries have to figure out. But I just point this out just as a perspective to show what percentage of our manufacturing is in the US. Now, if you look in the late 90s, it was up to 25%. Now it's closer to 16%. It's gone down a lot. Unfortunately, this doesn't show back further than the 90s, which is what I would really like to see is in the 70s, 80s, because during that period, there was a lot more manufacturing in this country. So I would have loved to have seen that. But realistically, the manufacturing has been shuffled off to a lot of different countries that are smart, low labor costs, places like China, like India. You got Vietnam, you got a lot of places like that over in Asia that, there's a lot of really smart people that are willing to take a lot less of a wage. So obviously manufacturing gets offshore there as opposed to this country. A lot of people in this country, they fight and say, well, we need higher paying manufacturing jobs. Like, there's a reason that you don't have as many jobs because you're charging too much, right? Compared to other countries. I'm not saying that there's not a value there. I'm not saying that people aren't worth it. I'm just saying that if you look at a global wage, what's the lowest cost, right? These companies are out to make money. So if the lowest cost in Vietnam as opposed to the US, manufacturing is going to Vietnam. So just something to keep in mind, just in the perspective of manufacturing, because a lot of manufacturing jobs are starting to move back to the US, but it's not going to move the needle in comparison to this chart. It might move it a little bit, but certainly not in a big way.
And Kirk, I want to add one thing on that before you move it. What I thought was interesting is, Ken, there is this talk and all these jobs, manufacturing job, has left the United States. And I agree with you. I wish this chart went back further. But from an overall global standpoint, I mean, if we go back to 1990, it's showing 21% to 16%. That 5% shift is about a 25% change in the amount of share of world production from the United States, which is a lot. But what's interesting is it doesn't correlate to the amount of gain that China's had by any means. As a matter of fact, it's one of the smaller ones. What's really interesting is Japan. You go from Japan was looks like about 14, and now they're down to just above 5. They've had almost both them and Germany have had over a 50 to 60% decline in manufacturing. So what's interesting in this chart is just seeing that where China is gaining from isn't as much from U.S. manufacturing shift to China as to China is getting this manufacturing growth, taking it from a lot of other areas too, which of course it does. It only gets into 5 countries here. So it'd be very interesting to see where where this biggest shift has occurred to China. And I would imagine that one of those is Taiwan, because I remember back in the 80s and 90s, we used to see a lot of stuff made in Taiwan. I don't see near as much as I used to.
Yeah, so that's something to watch, right? There's going to be a lot of changes in the upcoming years with U.S. manufacturing, global manufacturing, a lot of shuffling around, moving from China to other places like Vietnam and India. There's a lot of shuffling around right now. I know Biden just hosted Modi at the White House, so I know there's a lot of trade talks going on with other countries and trying to shore up other resources. So that's going to continue as long as we have issues with China, which I don't think that's going away. There's just too many conflicts to resolve peacefully. I mean, you could say peacefully, but it's just, it would be going on under the surface as opposed to what we can see. So here's the next topic, and I think this one's really important. So one of the things we talked about last week and other weeks is the economic data in the U.S. is confusing, right? You've got low unemployment, you've got stagnant wages, you've got rising GDP, and you've got rising rates, and none of these things make any sense to anybody. Anybody I know that's of note is saying they're expecting the markets to correct significantly in the near future, and they think that we're already well overextended now. That may be the case. It doesn't mean the markets can't keep going higher. But here's one thing I want to point out. So this chart is showing bankruptcies. And bankruptcies are really important because you don't hear this in the news, right? You heard them certainly with Silicon Valley Bank, and you've heard of the FDIC banks that basically I don't know if you want to call it bankrupt. They kind of got taken over, but I would put them in the bankruptcy category technically because they're no longer solvent. But if you look at non-banking entities, right? So anything other than a financial institution, there's a lot of bankruptcies going on in the U.S. There's a ton of them, and these are, I don't know if this is measuring, I don't know if this is actually publicly traded companies, but there's been a rising amount of publicly traded companies that are filing for bankruptcy, and the private companies, there's a ton, and I don't have a chart for that. And I wish I've seen the numbers, I just don't have a chart for it. But if you look at the bankruptcies that are going on in the economy right now, this is where this gets into the wacky, crazy, topsy-turvy market, right? On one hand, everything looks great. Tech companies are doing great. The NASDAQ's up 30 some odd %, primarily because of NVIDIA and a few others. But if you look at the broad-based economy, the stock market's not up huge. And the economy is somewhat stagnant. Some things are up, some things are down. You're wondering, hey, what's going on? Should things keep going up? Should they be going down? This is what we call the messy middle, right? There's no clear direction. It's not like, oh, the Fed's printing a bunch of money, let's just go to the moon, right? This is more messy middle, not sure what's going to happen. They're talking about raising rates. I'm not convinced they're going to raise rates. If they do, 25 bits, maybe the most. I think beyond that, they're really pushing the envelope. And I don't think they need to. I think, inflation's dropping significantly. I think it's going to continue to drop. But that being said, bankruptcies are a real indication of the economy. If you can't put numbers to a page and balance your books and pay your employees, you don't stick around. And that could be due to a variety of different factors, right? So inflation's gone up, which means that goods and services can now be charged a higher rate, right? You can charge more for your goods and services. For like gasoline, if you're buying it for, let's say, $70 a barrel, and you could sell it for $90 a barrel, great. If it goes up to $90 a barrel, you just, you keep your margin and you keep charging that. But it just means that effectively the consumer is going to pay more. In some cases, they can't, right? So it could be that your products or services are just too much of a commodity and you can't charge more, right? For whatever reason. So there's going to be a lot more bankruptcies, either due to you can't find enough labor or the costs are rising way too fast. You can't keep up with revenue. All these things happen in these challenging times. And we're going to keep having a challenging period of time, probably for the next 10 years. And I would expect that if you look here, the bankruptcies have spiked, just like they did in 2020 and just like they did in 2008 and 9, right? We're not yet at those, we're actually close to those levels. I'd say we're at those levels. We're not at the high point. I think we could even go higher. We're already halfway through the year, and we're already seeing, it says here, we got 8 filings for the 12-week moving average. So I think very easily we could spike up, but we'll see. But I just want to point that out because bankruptcies are one thing that we don't talk about all that much, but under the surface, they're a real canary in the coal mine when you're looking at macroeconomic factors. You'll never see this in too many charts, but it's something actually to watch if it spikes up. This is one of those handful of things you don't watch too much because there's nothing to see, but when they do spike up, you really have to pay attention. And then let's see, the last chart, there's actually 2 more. I'm just going to mention this one because it's fun, is 1/4 of the U.S. 40-year-olds have never been married, a record high. Now, we did have Jay Zygmunt on the show recently, and he's an advisor for, I think it's child-free wealth, so for child-free families. And there are, surprisingly, I think he says like 25 or 30% of families in the U.S. are child-free. Now, I haven't dug into the data to know whether that means you're married and don't have kids or whether you choose not to have kids. I can't speak to that. But that's a huge number. And we heard before about the millennials and the next generation, Gen Z, not wanting to ever get married, not wanting to ever have kids. This kind of nomadic kind of personality. I'm going to travel the world and not going to get tied down to a job. It's just fascinating to see the trend. Right. And as we talked about earlier, trends don't mean it's going on forever. This doesn't mean, in another 30 years that no one is going to be married. But it's certainly a shocking, alarming trend that fewer and fewer 40-year-olds are not getting married. And there could be a plethora of reasons for that, which I'm not going to get into, but I just want to point out because it was interesting to me. And the last one I'll point out, and I'm going to send over to Doug, is Actually, sorry, we got a few more. We'll get into. Let me get one more, and then we'll get into the housing if Doug wants to talk about it. So last one for me is this. I love this chart: dividends and buybacks. This is the core of one of our strategies that we've done for years, and we've stopped doing it because, frankly, the environment is not conducive to this. But normally, it's a great long-term trend. This is considered one of the better strategies to use. Is focusing on stocks that are buying back shares, paying dividend, and increasing the dividend over time. Now, if you look at this, what this shows is the S&P 500 stocks, dividends paid, and buybacks. Now, what you should note here is an enormous amount of buybacks since 2009. And typically, it's not really all that telling as you might think. You might think, oh, these companies are smart. They're buying back shares when it's cheap. No, that's actually not why they do it. They buy back shares because, think about it this way. You're running a company, Acme Company. You're selling dynamite to the Wile E. Coyote, right? And you're making good money, right? Every week he comes back in the show and buys more dynamite. So you're selling this stuff, right? So you've got there are times where your stock may be at 100. There may be times where your stock's at a 20, right? Maybe it should be a 50. But somewhere it's going to bounce between that range for that stock price. Now, typically you would think, well, if it's a 20, you buy back a ton of shares, and if it's 100, you don't buy back any. That would be logic speaking. However, corporate CEOs are rarely governed by logic. It's usually by shareholder sentiment. So what should happen is when things are cheap, they should be buying back a ton of shares. As you can see here, 2008, 2009 was the lowest amount of buybacks that you could see. The highest was 2021. And then 2020 was a low point. So obviously these people are not that smart. They're very smart people, but the decisions are not based around logic and intelligent decision making. Now, that being said, one of the reasons that they do this, and this has become a trend in the last 20 years, the reason they did this is, I guess you call it kind of like strategic corporate finance, right? It's trying to manipulate earnings, share price, and all that. So what they tend to do is, let's say let's take Warren Buffett, right? Warren Buffett has claimed if I think it's like 1.2% book value. If his stock price gets below that, he's going to buy shares. I think it's something like that. So he's laid it out. He's saying if it goes below this price, I'm going to buy back shares. Because in his mind, his return is better in his stock price than it is anywhere else. Now in 2008 and 2009, he was walking around like a kid in a candy store, handing out money to people who needed it and getting huge paydays, right? But you don't see that from CEOs typically. What you typically see is them saying, well, if we invested in this new manufacturing plant, it would earn us another 20%. Okay, great. That's what that would earn. However, if we buy back shares, it's going to earn us another 30%. So they buy back shares, right? They're looking at their opportunities saying our best opportunity is buying back shares, not investing in the company. Same thing it's the same principle we talked about a few weeks ago with ExxonMobil, right? ExxonMobil, huge profits, like one of the most profitable companies in the S&P 500, because they're not reinvesting in their capital expense. They're not reinvesting in wells and rigs because the government is disincentivizing them to do so. So they're not taking all that cash and reinvesting, or taking all that cash and paying out to shareholders. Now, ideally, what they should do is buy back shares. That would be a logical approach too. That would be a good approach for them to take. But that's not the choice they've made in large part. So, point being is the reason that shares are bought back is not always for the reasons stated in the media. Actually, it's relatively rarely because of those reasons. A lot of the reasons because it is the best return on capital that they can get without cash. And because stock prices have gone up so much, it's much easier just to buy back shares, which you've seen has skyrocketed. And all right, Doug, I'm going to leave it off to you, and then we can wrap it up.
No problem. I actually, I think I mentioned this last week. In a way, buying back shares is kind of like what Omega did with their watches, right? If you're trying to entice people to invest in your stock, and of course you have stock options yourself in the company, And one of the ways is organically to make Wall Street think you're incredible and beat those estimates. Another way is to reduce the supply. To reduce the supply, what does it do to the remaining share price of the shares, right, Kirk? So it's a great way to drive your stock up. And again, a lot of the companies that are doing this are not typically dividend producers anyway. These are a lot of those same growth stocks, and tech stocks are a huge portion of those buybacks. The other thing, and I'm trying to get it posted here for you, Kirk, but I saw another chart that was a good chart about the savings rate in the United States, and I'll get it here. I'll post it later. But basically, there's another chart that was excess household savings, so personal savings above pre-COVID rate of 9.1%, billions of dollars. So if you look at if you look at this chart, you'll see the cumulative excess savings went from 0 before COVID, okay, and it went up to about 2.1 2 trillion, so billions of dollars, 2.1 trillion dollars, and it has, and this is not predictive, so we're not looking beyond that. They're showing exactly where it was as of current. The last marking on this was January 23, so I think it's probably, my guess is that it's ending at July of 2023. But basically, it has come back down from 2.1 in excess savings to 533 billion. So that's a significant drop. And if you look at where it is in terms of personal savings exceeding pre-COVID level, there was it went up as high as about 600 billion, but about middle of 2021, it's been negative since then. So it is now worse than it was pre-COVID. It's lagging that, and it's dropping significantly. And the reason I'm bringing that up, again, no predictions, but as we talk about, what have people doing? What's holding up? What is a massive piece of the economy is consumers spending. And if consumers are spending, they have to have that money coming in and going out. And if that money coming in is greater than they're spending, they're going to be able to save. If that money coming in is less than they're going than what they need to go out, then they're going to go into a deficit. And we're starting to see with credit cards going up, and if we're starting to see as savings rates are going down, all of these things are starting to just kind of give an indication. As you talked about, bankruptcies are starting to go up, and that's, there's corporate bankruptcies, there's personal bankruptcies. All of these things are can be an indicator that we are starting to see a real pressure that is forming and starting to bubble up in household budgets. And if we go back to the beginning of our conversation, this is where all of a sudden you start looking at things like student loans and higher interest rates and higher minimum payments and student loan deferment starting. And now, even though they tie that student loan payment into based on your income, a lot of people that were in deferment make a decent income. They don't make what the government would declare to be poverty levels. A lot of these are families that are making six figures, which doesn't go as far as it used to. But yet, based off of the metrics of what is required to be a calculation of what is due to be on payments on the student loans, it can be a significant impact to household budget. All of a sudden going from no student loan payments to several $100s worth of student loan payments every month that is being piled on top of higher credit card rates or higher credit card balances. And ultimately, that means less money available for consumer spending, which our economy obviously relies on, or at least temporarily using debt in order to keep that consumer spending going until, as you mentioned, Kirk, at some point it becomes a breaking point. At some point, consumers can't afford it anymore, and that's when things start to pull back. And so, do I foresee a situation here? I finally found that chart. Do I see a situation in which this is going to be, an impending doom? And they've been talking recession for God knows how long. You did show that one chart, Kirk, about the bankruptcy spikes. And what was interesting about that is, if you notice, and granted, it only went back to 2000, early 2000. So it didn't count for a lot of recessions. But you'll notice that a lot of the bankruptcies, at least the two examples that were on that chart, the bankruptcies spiked after the recession hit. The latest bankruptcy spike, we're technically, at least not on that chart, in a recession yet. So if they've already spiked and we're not in a recession, I think that's also a concern. What happens when we actually hit one, right? Because spending has still been pretty stable. I mean, anybody can walk out, regardless of what they're telling you, go to the stores and say, geez, people are definitely buying. And when that stops, that's going to be a challenge. So anyway, that's a couple of thoughts added on to some of those charts you were showing and as you rolled through them. As I know we're up on the hour, if again, we talked about the student loans and we talked about student debt. It's not going away. The government and Congress can change this. It's up to Congress now. Don't blame SCOTUS. Don't blame the president. I know there's a lot of finger pointing going on, but at the end of the day, it comes down to your senators and it comes down to your congressmen. It's weird what's going on in my background. I don't know if you can see that, Kirk. It's dragging, but you know what? It comes down to them. So if you really want to see change on this, you need to elect that at the congressional level, because it's going to take a law to allow for that to go away. And probably the simplest way for this to happen is for it to become part of normal bankruptcy, right? But right now it is not. You cannot get rid of it through normal bankruptcy channels. So, and in light of that, it becomes even more critical that as you're dealing with college, you make critical choices in terms of where your family goes to school, where how you're going to pay for it, and how much debt you're willing to take on. If you have questions about that, we can help you make sure that you're going to find a path to get that education and be okay academically, financially, and socially. Go to our website, ProCollegePlanners.com, and learn more about it, because it's going to be critical. You need to correct the student debt issue before you get into school, not after.
All right, so we're going to wrap it up here. Let's see. All right, we're at the hour, so we're going to wrap it up here. Well, thanks again for everyone joining us. Hopefully you're somewhere warm, somewhere having a good time, enjoying time with the family.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.